Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called The Aussie Dollar, Where to Now? Today, the team will discuss the global macroeconomic factors from around the world that affect Australia and the Aussie dollar. Then we'll give you our view on where the Aussie dollar is likely heading from here. So join us today to find out. Just a reminder, the information in this podcast is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact, and you can book a call with me to have a no obligation chat. Today, as always, we have Damien Klassen, Nucleus Wealth's co-founder and chief investment officer. Damo, welcome.
Hey, Sam.
I'd also like to welcome David Llewellyn-Smith, Nucleus Wealth's chief strategist. Dave, welcome.
G'day. How are you?
Very well, very well. Great to have you back. My name's Sam Kerr. I'm the senior financial advisor at Nucleus Wealth. We are live every Thursday at 12:30 Australian Eastern Time, so jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform, as our show is available on all the majors. So that's all the housekeeping out of the way. So Dave, over to you to get the ball rolling.
Thanks, Sam. So we thought we'd revisit the Aussie dollar today. Haven't looked at it for a while, and there's been some, reasonable volatility of late that may suggest more to come. I've titled this presentation with the, dramatic prediction that the Australian dollar will go to 40 cents, and I'm going to explain to you why I think that's the case. Not imminently, but sometime over the next cycle. So we're going to run through the forces currently acting on the AUD and what we think will come to bear on the next business cycle as well. So we'll have a look at monetary policy here and in the US, first of all, to look at yield spreads, that is, the differences between interest rates that can, bid up or pressure a currency. We're going to look at China and, why we think that it's got a structural bust going, basically a permanent growth adjustment lower. And how that's going to play out for Australian commodities, where we are in this business cycle, how that'll affect the AUD, and then, we'll wrap up with a look at the next business cycle, what we think will be the pillars of growth in that one, how Australia fits, and how that will affect Forex, especially the AUD. So, without further ado, the Fed is still hiking and the RBA is all but done. Now, that title is, implicitly AUD bearish, and I do think that interest rate spreads are likely to pressure the currency from here. Principal reason for that, the Fed is still hiking rates. I think that there's at least 2 hikes to come there, and it's possible there'll be more. The principal reason I think that the US economy has held on so well this year, after looking very shaky at the end of last year, is the AI bubble in the stock market, which I think is supporting wealth and consumption in the US, and therefore, delaying the fall in inflation, especially core inflation, which is being held up by, a labour gap post-COVID in the US. So to unpack that a little, the AI bubble is sort of the artificial intelligence bid that's come into the US stock market over the last couple of months and driven, associated technology stock prices to the moon, with really high valuations and sort of fabulous forecasts for earnings. Now, we actually don't think it'll be that good for the tech side of things in the long run, but for the time being, there's been a few profit results, Nvidia in particular, that have supported that narrative, and so it's gone a little bit bonkers. And in the short term, you do get, I think, wealth effects that support consumption. There's a very strong correlation between retail and the stock market in the US, and so I think that's playing a role. The labour gap that I've referred to here for the US, which is, I think, kind of the key pillar of sticky inflation, is that basically the US lost 5 million workers during COVID for various reasons, which is more or less permanent. It's kind of trickling back in a little, but a lot of it was retirement, early retirement, etc. People, obviously were less inclined to go out in public in the US, given it had no kind of public protections against the virus, no lockdowns, etc. And now all that, as well as no immigration, and all that culminated in a very large labour gap that will close as the borders open and things, but it's still structural, which means wage inflation in the US got much higher than in Australia, and is still much higher, and is more sticky as well. So those two factors, I think, has the Fed kind of still chasing this sticky core inflation. I've got a chart up there for you which shows the critical measure, which is core PCE, personal consumption expenditure inflation. That's the core chart for the Fed, and it's still running at around 4.5% annualized, slowly coming down, but only very slowly. And they've got to get that to 2%. So that's going to take more effort.
And Dave, can you just explain for the viewers the differences between core inflation and the other ones on the chart there?
Sure. Core tends to be the less volatile components of inflation, things like housing and things, whereas wider inflation includes things like energy, which can fluctuate wildly, and so they're kind of peeled off to give us an idea of what core inflation is as a sort of stable base for inflation. The other lines on there, you've got core, just straight PCE, which is more headline inflation. And so that includes things like energy, which is why it's lower than core at the moment, because energy prices all collapsed from the big Ukraine war shock. And so they've actually driven down headline inflation. That's the CPI number that's reported. But the Fed is more concerned about the composition of it and the stuff that is sticky. So that's the main difference in those lines. So conversely, in Australia, I think the RBA is all but done. I think it may well be done. There's lots of evidence for me in sort of leading labour market indicators that we've got a labour market that is rolling over. We have much stronger immigration relative to the size of the labour market. So we've got a supply shock going. The economy is clearly slowing in, across the board, but particularly in consumption areas. And so labour demand is going to come off. And we never had the labour market damage that the US did. No loss of workers, no permanent harm. The main issue here was the swing in migration, which went out and then has come back in twice as strong. And so, we never got the wage inflation that the US had. In fact, we barely got to acceptable wage inflation here, and now it's falling away. And so that sticky inflation problem here is not as bad. And the inflationary impacts we're dealing with here are things like housing and energy that are actually immigration related. So, they can be either looked through or fixed, or the RBA can't address them. Not that they're not, still going to concern the central bank, but I think the net result is that the RBA is almost done, and we still have lots of embedded tightening to come here. And this is the chart I've provided on Australia, which is the fixed rate reset that we've talked about for some time for mortgages. Still is like absolutely at its peak now. It still has 3 strong quarters of resetting to go. So that's a lot of tightening still to come for households. As well, we're still only like 2/3 of the way through passing on the rate hikes that we've had so far to mortgages. So lots of tightening still to come to hit households and slow consumption even more. And so I think the RBA...
And sorry, what you're saying there, though, Dave, is that the tightening still to come is the stuff that's already been done, just hasn't flown through yet.
Yes, quite right. Yes.
Yeah.
So lots of tightening still to hit, and the economy in Australia is basically stalled now, and so there's every reason to think that it's pretty much cooked. So if the RBA goes again, I'd be surprised. I think the base case is that it's probably done. So that gives you an interest rate spread circumstance where the US is likely still tightening and the RBA isn't, which is obviously more bullish for the US dollar versus the Australian dollar. Excuse me. So that's our first point, and how important are interest rate spreads to a currency? Hard to know in terms of proportion of various factors, but certainly important, and comprise probably 1/2 of the major two inputs. Now, the second major input is probably the terms of trade, and that is the relative price of our commodities versus our imports. And this is where we come to our second discussion, which is the health of the Chinese economy, what's happening there, and what it's going to do to our key exports to China. So as mentioned in the intro, we think that the China bust is actually just a structural wind down of its catch-up growth period. In any developing economy, you typically get a very fast growth period of a decade or two when it has lots of young people, demographic tailwinds. It's got lots of cheap labour that allows it to create export industries, lots of infrastructure deficits that need rectification and investing into, and in China's case, a lot of big housing shortages as well, as it shifted a very rural population into the cities. And so that 20-year process, really was the China super cycle for commodities, has pretty much exhausted itself. China has built enough of everything. Not that it can't build more. In fact, it is building more to keep things sort of ticking over. But the point is, it's built anything that's sort of even remotely productive or economic at this stage. And although urbanisation probably has another 10 or 15 years to run, it's built everything out in advance. So there's plenty of empty apartments. There's oodles of ghost cities. There's fabulous infrastructure everywhere, and so it's really at this point building things just to keep people's hands occupied, not because it's going to advance the productive output of its economy. And China's authorities, Beijing, have recognised this. In fact, they've been talking about it for nearly 10 years, and they let it overshoot. But they have, in the last few years, gotten quite serious about trying to reform the economy away from this construction era that has dominated growth. Now, the core of this was, of course, the Chinese property boom, property construction boom, and it has gone bust in the most spectacular fashion possible. I've provided for you here the rolling annual of China property starts, which is just spectacularly down. Some, I can't even fathom, 60%, something like that, and still falling. And there's nothing to suggest that this is going to turn around. It may not even be able to be turned around. It probably could be if Beijing really, really panicked and threw everything it's got at it. But every day that goes past becomes more difficult to reverse because a number of factors. The developers that were part of the boom are no longer trusted in terms of delivering because they failed so often. Beijing doesn't look like it's keen for it to happen, but if it did reverse, nobody would trust that reversal would last very long. Prices are falling, and so there are lots of people underwater, and kind of we're seeing balance sheet deleveraging. It really is like a pretty classic housing construction boom or bubble and bust that's underway now, and we're into things like liquidity traps and pushing on a string and these kind of Keynesian phrases that capture the fact that the private sector has had enough of investing into this thing and has simply gone off it for good. So this was the key driver of steel consumption in China, and the key driver of the enormous iron ore and coking coal booms and build-outs that we saw over the last 20 years. So as it all reverses, we expect pretty serious adjustments in those commodities, in their prices. At its peak, Chinese property construction is probably 40 to 45% of total Chinese steel consumption. It's down 60% in starts terms now, but is being offset at this point by some infrastructure and lifted completions of a lot of half-finished property inventory and other factors. But fundamentally, as this washes through, we're just going to see a lot less demand for steel from this sector, and probably infrastructure as well, because the two are linked via local governments that did make a lot of money from property, especially land sales to developers, and they recycled that money as infrastructure. So that is going to diminish as well. And so the end result over years is just a lot less demand for thermal coal and iron ore, and we see these commodities adjusting to historical average prices. Coking coal at somewhere under $100 or just under, and iron ore around $50-$60, with probably overshoots to the downside at times. So this process means that Australia's terms of trade, the price of its major commodities, falls relative to our imports, and it's like a big pay cut for the economy, and typically that as an input is very bearish for your currency as well. So those are the two major kind of legs of the Australian dollar's value, both of which are looking pretty shaky right now. And when I say right now, I guess I'm talking the next 6 to 12 months. So that sort of brings us to where we are in the business cycle.
Hey Dave, we're just going to go to a quick sales message.
Yep.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show. And you're back on.
So yes, sort of step 3 in our assessment of where the AUD is heading, the relative short term is, an assessment of where we are in the business cycle. Excuse that, it's just my marvelous children. And, we see ourselves as, very late cycle, and, even with a foot, into a sort of end of cycle shock period. we've seen the Fed break various things. Whether they've broken enough things yet is still an open question. I've provided a chart here on US bank credit, which, as you can see, is like in free fall, and year-on-year growth is the lowest it's ever been in the modern era outside of the GFC, and is still falling. So this is one potential candidate for something that the Fed is going to break that will cause, the US economy to finally succumb to recession. But it could be anything else. It could be business credit, could be the consumer might have enough. The AI bubble may collapse on itself, or the Fed burst it. Earnings forecasts have rolled over and started to go down again. And we think that the combination of slowing economic growth with slowing inflation is going to be really pretty toxic for earnings. Even if we don't get a severe recession, it's enough to really sort of beat up margins, which expanded so much during the last few years. And so that might be enough. We've got, if we look at the global situation, Europe is basically in recession and is going down, is going down further faster. China is barely growing at all. It's certainly going to reach its growth targets, but largely on base effects. And China and Europe tend to go together. There isn't much scope for a big China stimulus. We're just not seeing that mooted from authorities. Of course, it could come, but it's at the base case is it won't. It'll be more incremental stuff. And so, we still have yet to play out the end of this cycle, which, in effect, will have been brought about by central banks fighting inflation, and a pretty classic denouement for a business cycle. And generally what we get with one of those things is a safe haven trade. When equities start to realize that earnings are going to fall and come off, and we've still got this circumstance in which the global growth isn't likely to be any better than the US, and probably worse. We may well see a safe haven trade into the US dollar. So there's another short-term impulse for a lower Australian dollar. I would think, if this transpires and the US growth finally rolls over and delivers another blow to the European and Chinese economies, then commodities have another leg lower too. So, all of this is pretty bearish AUD. So that.
Dave, we've got a question here. So we've got a question from Cam. He's asking if Australia goes into recession and the US doesn't, will the Aussie dollar get slammed?
Yes, that's an easy one.
Short answer.
Yeah. I think the thing is, yes, that's absolutely right. But maybe the best way to answer that question is to actually go on and look at what we think of the next cycle, because the US-Australia comparison, if you think it's bad now, it looks like it's going to get a lot worse as we go forward. So did you want to throw up another message, Sam, or are we?
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
And so looking forward now in our final assessment, looking, I guess, beyond these short-term influences, but in sort of projecting ourselves into the next business cycle and the long-term prospects for the Australian dollar. It's pretty gloomy. like what's clearly shaping up as a bit of a revolution for the next business cycle is artificial intelligence, which is led by the US with a distinct and clear leadership. So for starters, that's likely to result in a stronger productivity surge in the US than Australia, as well as a greater number of winners directly from the AI boom. And relative to Australia, we have virtually none of these companies. Moreover, our growth model right now and for the last few years has been just completely addicted to immigration, and as we call it, quantitative peopling, which is very disproductive because it doesn't encourages low wages over automation, which is quite disproductive, and then capital shallowing as well. That is, you've got more people crush loading all of your fixed capital, and that's really productivity negative as well. And so it basically slows you down and chokes your economy. And relative to a sort of artificially intelligence-juiced US economy boom, it's going to look pretty bloody boring down here by comparison. And there are other features of the forthcoming cycle that are pretty gloomy as well. At the moment, the US is enjoying an outrageous reshoring boom as China de-risking kicks into gear. There's massive investment in manufacturing capacity.
Well, they have an industrial policy, don't they?
They have an industrial policy.
That sounds like a novel invention.
Lots of reshoring in tech, but also in the petrochemical sectors, because they've got really cheap energy in the US. Gas there is like $2 a gigajoule. And so, for them, yes, they've got higher labor costs still than lots of emerging markets. But if you automate, that's not such a problem. And so, for the US, this reassuring thing is real, whereas in Australia, it's not real at all. We're still...
Well, it looks like our best hope is other people, though, isn't it, Dave?
Well, that's right. We're still hollowing ourselves out because...
Yeah, but we've got... it's sort of in a way, you say Australia's industrial policy is determined from what other countries are doing. So for the last 10, 20 years, it was determined by whatever China was doing. That's what we were, we're supplying. And now, best hope for some of this commodity processing, actually upskilling some of that stuff is that we fall into the bucket of US friends, and so they'll actually help support us in terms of giving us tax credits and things like that if you're doing some of that here.
Yeah.
And then potentially Indonesia is looking to try and trying to leverage its nickel, and so it's trying to convince us to do something, to have an industrial policy with our lithium, like that, just over the last couple of days.
Yes,
so
it could be similar with China and steel, like green steel.
Yeah.
But
we're just here hoping somebody else will come up with a good industrial policy that happens to include us.
But I mean, at the end of the day, the greening impulse, if you like, is something promising for Australia. But our energy costs are so outrageous, despite having some of the cheapest energy in the world, because we mismanage it so fantastically, that it's a huge deterrent for any kind of commodity processing. The exception is probably green, in areas of greening, so or decarbonisation. So there's some hope there, but at this point, there's just nothing. Productivity is terrible. We don't have tech, and so the competitiveness issue is huge. Unless you maybe put a massive sort of carbon price overlay on it, we might have some chance. So anyway, we're largely going to miss out on that boom, at least until there's some sort of conflict at China, at which point we might panic and invest in a few things. Then we have, like what we think will be a Chinese commodity super deflation, not a super cycle, but a super deflation, where iron ore and coking coal just basically fall forever. because this Chinese fixed asset catch-up growth is over. Now, there'll be much stronger growth in ESG commodities, which is again what we're talking about in terms of the green commodities and things. But our exposure there is just too small. It's nothing like what it is in terms of earners of our traditional bulk commodities. So, you know, you can get some offset there, but nowhere near enough. And so again, it's very deflationary, very bad for national income, and it could just run on and on, as it did after the Japanese boom of the 1980s, where for 10 years iron ore fell all the way down to, I can't remember, $12 or something. So, you know, we've got that kind of prospect in our key commodities, and that sets you up for, you know, kind of what we went through, you know, as a dry run, if you like, from 2012 to 2020, where, you know, very high commodity prices busted as China, you know, toyed with ending this growth model before, you know, letting it take off again. And then we also, you know, it was partly the result of the supply side boom, and suddenly there was just too much of every bulk commodity and prices crashed. And so we went through this process through that period. We know what it looks like. It's just smashed nominal growth, no wage growth, no income growth, very deflationary. And this time we'll have, you know, some AI job losses thrown into the mix as well. So, you know, it's a pretty difficult kind of environment, likely to result in sticky unemployment, constrained budgets, both state and federal, you know, as corporate profits dry up from the commodity sector. And, you know, maybe even some rolling energy shocks, because we still haven't fixed any of those issues. So it's really a circumstance of you know, we called this the lost decade when we went through it last time. It's really a rerun of that. It's an internal paralysis that, you know, will probably, I think the chances are it will be reflected in an external adjustment, because you know, you just be growing so slowly that you know, you don't attract much investment flow, and your interest rates tend to fall below everybody else's, and so you end up with a much lower currency as well. And so that's really the scenario in which you might get to a 40-cent Australian dollar, or an Australian dollar in the 40s. It's one in which you have the US economy, you know, booming, a la sort of late 90s, with you know, an artificial intelligence rollout that boosts productivity across the economy, lifts its, you know, growth capacity while it transpires, low, you know, sort of lowish inflation, but a tighter labour market than elsewhere, so higher wage inflation than it's had previously. It's like a really decent demographics. It's a really good kind of story for the US, which you could, you know, very easily get, you know, Forex leadership out of. Then you have China winding down to what is virtually zero growth over the next 5 to 10 years as its catch-up period ends, and Europe is like a second derivative of China. So, you know, you've got very slow growth in EMs and in Europe. And then you've got poor tired Australia that's attached to the latter, doesn't have enough of the former, and is really, you know, just a kind of forgotten and sorry little economy addicted to its immigration to hide its problems. So you get a very, very good story out of the US. You get a quite gloomy story out of Australia. And if you get, you know, relative Forex valuing those two narratives, then you get a very low Australian dollar. And that's, you know, kind of the story behind how we might get to a really low valuation. Not unlike what happened in the late 90s, where, you know, Australia was suffering from, you know, the post-Japan commodities price just unwind that went on and on and on. And the US economy is growing, in some quarters at 5 and 6%, through owing to massive sort of business rewiring with the rise of the internet and associated companies that lead the tech sector as well. And so, you could rerun that scenario.
Nice one, Dave. Thanks for that. So we've had a few comments come through. Cam's just saying thanks for answering his question. And he's saying, so buy unhedged US ETFs, he's guessing. Had a couple...
Or Nucleus Wealth international products.
Exactly. And Robert's also put a couple of questions here. Robert Chandra, he's asking, what's the incentive for the Australian government to increase productivity when we're so spoiled by the riches of our resources? And then he further adds, especially if productivity will increase unemployment through less skilled people losing jobs, and it'll drain welfare, social security, and lead to less tax revenue receipts.
Well, you kind of misconceived productivity a bit. I mean, high productivity is typically good for employment in the net sense. Now, obviously, when you get automation in certain sectors, and what we're going to see with AI is we think, particularly service-oriented businesses with a lot of low-end people, are going to be able to shed a lot of staff and automate, their functions. Now that sounds like unemployment, but if that lifts the profits of the business, it end up, in them employing more high-tech people, like more upskilled people, then there's actually an increase in income for both consumers and the business in net terms, and then the people who lose their jobs, will be upskilling to get similar positions in other businesses, and so productivity gains aren't employment negative; they're actually employment positive. So the incentive is actually
in the very, very short term they can be.
Oh yeah, in the very short term.
It's effectively the arguments about saying, I shouldn't have a tractor on my farm. I'll just get everyone to do stuff by hand, and that'll be better for employment.
Well, that's the Australian way. Yes.
Yeah, that's right.
but it's not better it's not better for living standards. Is the point? Yeah. You've got more people with more money if you get the tractor, because you've just produced more from fewer inputs. And so you've freed up resources to do other stuff. And if everyone's doing that, then it's all rising at once. So that's the incentive, is rising living standards. But the problem for Australia, the word spoiled is probably the right one in the sense of milk gone off, not in terms of having too good a time. Because the commodities sector is poisonous. Like, it corrupts policy. It campaigns to be undertaxed. It drives up your currency. It charges you immense prices for your own energy. And I
was commenting just the other day on this, saying that given how little tax it pays, it's actually a little bit embarrassing in the way that, maybe we've got politicians who have effectively been bought out by this lobby, but it's a little bit sad how little they've been bought out for, like a few $1 million a year in donations, and they're saving themselves tens and potentially hundreds of billions of dollars in tax.
Yes,
and well, if you're going to have a corrupt government, they may as well actually be smart enough to get paid properly for it. So.
And they don't employ anyone.
Yes. Yeah, exactly. Well, they do. They get to say these massive numbers about, we're going to have 4,000 people working on this project, and then when you get into the fine print, it's yes for the first 6 or 12 months, and then we're back to.
That's
40.
right.
Yeah.
So it's this is why it's called the resources curse, because it comes with massive downsides. Now, no, I'm not. Don't get me wrong. I'm not saying it's not good to have. The problem is that, and there are examples of people who manage it well, like Norway, for instance, who does manage it well. But we don't.
Many more examples of economies that manage it badly.
There are, yes, most of which are emerging markets, and that's really where we belong, quite frankly. We have the values of an emerging market, the transparency of an emerging market, and the structure of an emerging market. So it's more a case that resources spoil Australia in the sense of poisoning it, and so we end up with very, very poor policy making.
Nice one. So we've had a question from Matt Pettiford. You may have sort of touched on this. So he's asking, how does record migration moving forward play into this? And then goes on to say, I assume it's supportive for the Aussie dollar?
No, it's not. It's the opposite. It's not intrinsically negative for the Aussie dollar. But in the circumstances that we're facing, I think it is. Because it's deflationary for wages, disproductive, and in the circumstances of what we're looking at, potentially a global productivity boom and higher wages elsewhere, especially in the US. Then, quantitative peopling, as we call it, because it's not really immigration, it's a deliberate policy to grow the economy in a certain way that benefits vested interests and hides the failure to reform by government. It's not constructive, and you see lots of inequities that come out of it, like we're seeing at the moment, where youth is completely marginalised from housing. You see high house prices, which at the margin may result in a higher currency, but not in the circumstances of deflation that we're talking about. And so no, it's quite currency negative in these circumstances. Not good. It's just not good for living standards at all, especially in this kind of environment. I mean, traditionally, Australian policymakers in this kind of environment would cut immigration. They always have, until we went through this circumstance in 2012-13, when the coalition government of the day, instead of cutting immigration to protect the labour market during the mining shock, they ramped it up, which was an unprecedented experiment and did exactly what we expected it would do, which is triggered a property boom amid a deflationary bust, ended wage growth, kept very sticky high unemployment, and it was all much worse than it needed to be.
It's stats padding, though, in the end, isn't it? So basically saying I'm going to make things worse for individuals, but the overall economy will look like it's better, and so you've padded your stats.
That's right.
And
stats padding. Whereas traditionally policymakers would look at per capita measures of income and GDP, to gauge living standards, and so they would cut immigration, which would lift those per capita standards. But now they do the opposite, and so per capita standards fall, while it looks like the pie is growing, but everybody's slice of it is actually getting smaller. So it's quite sneaky.
Okay, so we've got a couple of other questions, but we'll just put out a final call for any other questions that come in before we get into the next section. So now we're going to have our question of the week. This is for viewers to have some discussion in the comment section over the coming days. So the question for this week is, where to for the Aussie dollar? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. So over back to you guys for the investment implications.
Yeah, so I expect the Australian dollar to basically go through a bit of a roller coaster ride over the next 12 months. Initially, while we wend our way through this end of cycle stuff, it'll be going down. once that sort of starts to bottom out, and markets get the sniff that global growth is going to lift, then the US dollar will fall and the Australian dollar will rocket back up. I don't know what those ranges will be, but somewhere. I don't expect it to be outside of where we've been over the last few years. But then I would expect a long grind of the Australian dollar back down again if these narratives that we've discussed hold. And so I'd be looking at this as basically a sell the rips strategy in the Australian dollar over the next, few years. And, whenever it's up, I'd look to, buy offshore assets. I guess take profits when it's down. For now, it's buy bonds, Aussie bonds. Stocks later, once we get a decent correction. And when that comes around, I'd be avoiding China exposed miners. You could look at, more of the ESG mining if you're interested in getting into the sector. I think the banks in Australia will be okay because, in this sort of disinflationary environment, we're likely to see rate cuts and rising property prices. And so I think they'll be all right. And immigration will be, they'll keep the foot on that to keep housing afloat as well. Non-mining offshore earners on the ASX, if you prefer to invest here than overseas. And everywhere, including Australia, I'd be looking to deploy, looking for those who are, at the front end of the curve on quality services firms that have, large headcount in low-end employees that can really maximise AI to boost margins. So that's how I would use the Aussie dollar over the next few years.
Nice one. So we have a question from Sammy J. He's asking, do you think the current account surpluses will help prop up the Aussie dollar for the next couple of years?
Yeah, they are now, but they're largely driven by the very high prices of our bulk commodities, some of which have already completely crashed, and so there are moving averages that determine longer-term contracts, 6 and 12-month contracts in the coal market, for instance. And so they're going to catch down over the next 12 months and keep falling. So I would expect the Australian surplus to disappear over the next few years. But certainly while we have it, it is supportive, yes.
Okay, great. And a question from Glenn Cahill asking, can the RBA intervene? And if it can, how much ammunition does it have? And also, how can we tell if the RBA is intervening?
I wouldn't worry if it does. I mean, the market will determine it. It's not going to intervene in any way that is material. It can lean against stuff it has at times, but it's not really worried about the currency for the most part. If these circumstances evolve, it'll be happy to have a lower currency. And if it is intervening, it'll be marginal and not worth worrying about.
Okay, and we have a question from Richard Dobosz. Just want to give a special shout out to Richard. He is very active across all our platforms. So thanks for the engagement. He's asking, how will the Aussie banks, especially the smaller ones, handle the likely turmoil ahead? And do you think any will go under?
It's an interesting question. I mean, there's a lot of early-ish stage distress in RMBS at the moment. Coming pretty much out of the fixed rate mortgage reset, rising rates. It looks like the 2021, 2022 vintage.
Sorry, just to define as well, the RMBS is the residential mortgage-backed securities, which is basically when a bank places a loan or a finance company places a loan and then bundles them all up and then sells them to outside investors.
Mortgage bonds. So the small banks use that more than the large. and the non-banks especially. So the 2021 and 2022 vintage mortgages look like they're going to have some pretty nasty default rates. And so it's, I mean, for us to actually see non-banks and banks to go under, you need to see probably a funding crisis as well, which is not my base case at this point, but things did start to get a little bit pear-shaped when SVP went under. So if our end of cycle shock coming out of the US turns out to be small US banks or similar, they go through another round of distress because they are still absolutely pumping Fed emergency facilities, then it's possible. Yes. I don't see any, we're not in the banks, the big banks. Like, we think that it's going to be bad enough. They'll need provisions, earnings will suffer, and there might be a little bit of pressure at the margin on funding costs, but that will be exaggerated in smaller banks and non-banks. So it's possible we lose a few non-banks. Yes. I don't see a financial crisis or anything though. Like, that's not what I'm talking about. Just a few casualties from the end of cycle bust. Not even an S&L crisis, I wouldn't think, but maybe something, smaller version thereof.
And part of that's people central banks are pretty focused on fighting the last war, and the last big downturn we had, they let a few things fall over, and that sort of caused issues, and so they're probably the finger closer to the trigger than what they would have otherwise had.
Yeah, I mean, if you look at what happened with SVP, I mean, the Fed was unbelievably swift and effective in bailing out the small US banking sector. In fact, you could argue that they were so effective, and this is probably the case, that they actually blew the AI bubble.
Yeah.
So, the regulators are very good these days at preventing contagion. And so I don't expect another big event of that nature, GFC or even S&L, but yeah, some casualties, yeah. Yep.
Okay, lots of great engagement today, lots of great questions. Apologies if I've missed any. That pretty much wraps us up for today. So thanks, Dave. Thanks, Damo. And we're looking forward to seeing how things unfold.
Thanks for having me.
Excellent. So if you enjoy our content, subscribe to our YouTube channel now, and make sure you don't miss out on any special episodes and future content. Also, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you share it with them. We do put out a lot of other content in addition to this podcast. We have regular articles that are featured in all major Australian publications, including the AFR, the Australian, First Links, and many others. To get all this, you can subscribe to our weekly Nucleus news and investment insights at nucleuswealth.com. We do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below or send us an email at contact@nucleuswealth.com. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.